Hey, everybody, welcome to another episode of the Under the Hood podcast hosted by Stallion Capital. Today on the show, we have Robert Persichitte, who is the founder of Delagify. Robert, how you doing?
I'm doing great. How about yourself?
I am fantastic. Thanks so much for asking. And I love that smile. We always like to start the show with jumping right in to get to know a bit more about you. So jump to your background, your kind of journey into becoming a financial advisor and your firm.
I have a bit of a non-traditional journey, and I spent most of my time in my career as an auditor. And I started as a fraud examiner for the state of Colorado. And basically, I was working with folks who have already been convicted of fraud, trying to recover assets for the victims of that fraud. That's where I started. I worked several different jobs in auditing and audit services, almost always with the main goal of finding the money. Wherever the money went, that was my job to figure out where did it go, how did it get there, how do we get it back to the victims. Now I work helping my clients keep their money by avoiding these mistakes, rip-offs, and taxes, because they all kind of go together. You can think of me as a auditor on your side. I'm the type of person who is looking at that analytical mindset of how did we get here? How do the rules apply to this? And really applying that to the client's needs.
I love how you do taxes in there like that. That was hilarious. I love it. So talk to us a little bit about what specifically you're looking at when a client first comes to you. Or is it from the get-go, helping them with their tax stuff, analyzing if they're involved in anything that's a little bit riskier than they might like, or is it something else?
Usually when a client comes to me, their spidey sense has gone off. They have something in their life and they say either I got this big lump of money or I've been working with this advisor and something just doesn't feel right. Something feels like it's a problem. And so my job is then to go in and do the analysis to see, all right, do we have a problem here? Do we have something that we need to address? Did you handle these taxes correctly? Or are we going to be able to handle these taxes correctly going forward? And can we fix this? If there's some type of problem, if you got into an investment that you didn't like, a really common one is permanent life insurance. It has its place. It can be appropriate depending on what the scenario is. But there's a lot of folks who get partnered up with salespeople who really push products that are not right for them. And now we have to kind of unwind it and get back to normalcy, get back to something that's actually going to make some real progress in their retirement planning and their estate planning, whatever they're trying to accomplish there. So to sum it up, usually someone's either worried about something they're about to do or worried about something that they just did, whether it's a big life event or a big investment.
I see. I see. And so a lot of that pain point is where you can come in, you can start to unwind that situation. But let's, I guess, back it up a little bit. What are some of in your auditing career, what are some of the notable red flags that consistently popped up for you to where you could tell whether an investment was legit or not legit, or like how the money flowed? Speak to us a little bit about that.
Yeah, so I want to separate kind of two different things, and I use the term very precisely. You have the term fraud and a ripoff, right? So fraud has a very, very narrow definition under the law, which is basically you are lying, you are misrepresenting something for personal gain that comes at the expense of someone else, right? It varies from state to state, but generally we're going to be looking for those three elements: that you lied or misrepresented something, you took something from someone else, and of course it was intentional. It wasn't an accident. You weren't mistaken. You were lying for the purpose of taking something from that person. And where fraud really comes up often is these too good to be true scenarios. That's really the kind of underlying theme that I get there. And a joke in the industry is we're just seeing the people who get caught, right? There might be a million people out there who are really good at fraud, and that was how they avoided it. But for us as mere mortals, how are we going to detect it? It really comes down to too good to be true, and they typically get paired up with someone who is not going any deeper than that surface level. So they'll say something like, he'll give you this guaranteed 20% return, and then you don't ask any follow-up questions, you don't dig in, and you don't figure out why, how does it work, what are the risks. They're kind of covering up what they don't want you to see. And that's really the main piece for fraud. Now, ripoffs, on the other hand, are a much broader category that I like to use, and it is a lot of times something where someone's getting a bad deal, right? A lot of times it's not fraud just because it's disclosed. And, I'll give you an example. One of my favorite examples, I had a client who had a contract for a private equity deal, and they went on and on about how great it was and how they make all this money and how they have these returns. And when you dig into the contract, what you'd find is that their fees were 12%. So not 12 basis points, 12%, which is astronomically high. Now, if she signed up for that, she would be upset. She would certainly be upset. And she'd say, oh my gosh, how is this consistently losing money? How my assets are getting eaten up so quickly, and it's so hard to unwind this. She'd be upset and say, I got ripped off. But it would not be fair to call that fraud because it was disclosed. It was there. It was in front of everyone. Anyone who cared to read the contract could see that they were disclosing it and that this was, there. Does that necessarily mean it's on the up and up? Does it mean that it was legitimate? That's a very different purpose of interpretation. And that has the same elements to it, though. It has the same elements of fraud of you have something that's enticing you, and the people are really good at making you not see, making you ignore what they don't want you to see.
Yeah. Yeah. No, that makes a lot of sense. And so really what you're looking out for is that too good to be true. And then that charismatic person who's trying to hide some of the details. Maybe you ask them a question and they kind of skate around it. They don't get straight to the answer. And then also, just making sure you read what you sign is also a good rule of thumb and that you know what's going on there. Well, I love it, man. So you have that auditing background and you know some of those red flags to look for, and you're helping a lot of clients either unwind an issue or avoid an issue that they are about to step in. And so after you've done some of that unwinding, which we can jump into that process a little bit more, I'm sure that'll be a theme throughout the show. What are you really kind of pushing them towards, or what do you go to stay up to date with like the market trends and financial strategies that will be optimal for them?
Absolutely. So the market is changing all the time, and there are always big trends. From my perspective, tax is going to be kind of the center of the world because those big moves and then unwinding is going to have a very, very large impact tax wise. And so I am very fortunate. I'm a teacher at Metropolitan State University of Denver. So a lot of my colleagues will keep me apprised of what's coming down at us from Congress there in terms of the tax side of things. In terms of the investment side of things, I am an avid reader of the news, and we can see the trends. One thing that I love is if you look at some of the bigger scandals with the benefit of hindsight. So I tend to gravitate towards fraud. But you look at how the market changed in 2001. That was not an isolated issue. That was not oh yeah, there's just one company here and that is harming people. Huge, broad market issue with Enron, of course, WorldCom, Tyco, these other ones that are falling through, that were falling through, but also big questions about earnings quality, right? So an example that I love is GE. Is GE the darling child of the market? Are they really as great as they claimed to be for the longest time? Are their earnings good quality earnings? Or is it just in the same category? Now the truth of the matter wound up right in the middle. The way that you stay on top of it is by reading the headlines to the newspapers. And Enron, especially, I've read the front page of the Wall Street Journal every day since I was a sophomore in college. Um, Not the whole thing, just the front page, and then you kind of make that decision: am I going to get more into this, or am I going to back out of it? And the information was all there. All the information was there, plain as day. The financial statements, if you dug into them, you could see it was maybe not adequately disclosed, but we had clues and breadcrumbs of what was happening. Fast forward, same thing with Bernie Madoff. The first SEC complaints against Bernie Madoff came from 2004, and so four more years of him just ripping people off, doing massive fraud. And it came down to, if you're paying attention, if you're looking at what people are saying, all the information is there. Sometimes it's just hard to act on it and hard to know how the markets will react. But I am very much a value investor and looking at how are we going to get consistent, sustainable profits while being aware of what's happening in the broader markets around us.
Yeah, yeah, I gotcha. And so, talk to us a little bit about, you mentioned quality of earnings. For those in the audience who don't know what that is or what that entails, speak to that a little bit.
So, quality of earnings is going to be when somebody gives you an accounting statement and says, we're this profitable, this is how much money our business is earning. You're trying to evaluate, one, how consistent is that going to be going into the future? How good of a predictor is this for long-term earnings? And two, is it the truth today? Is it accurate? Is this an accurate picture of what the company brought in? And you think that that is kind of straightforward and simple, but when you're dealing with these huge multinational companies, you have no idea what assumptions that they're making and how they are portraying their profitability there. They have an incentive to be as profitable as possible. The auditors have an incentive to make sure it's as accurate as possible, as faithful representation as possible. But there's judgment calls all the way up and down there. And ideally, we want somebody who is just being honest and transparent, but we don't always get that. So we have to evaluate, do these financial statements, what do they tell us about right now, and what do they tell us about the future?
Yeah, yeah, I gotcha. And I see how, if it's kind of a mom and pop shop, maybe 1 to 2 million in revenue, you can predict that quality of earnings a little bit easier than if it's, a huge Google or Amazon. It's like, must be difficult to really nail down those quality of earnings there. So we've talked about, a little bit about what red flags to look for, where you're getting information about the markets. The relationships at the college is clutch, by the way. That sounds, for the tax information there, and then reading the headlines. But talk to us a little bit about what the headlines are saying today, about what factors to really pay attention to in today's market, and then what your high level strategy is to address those factors.
Yeah, this is a really interesting market, and this is a really interesting time politically and economically. And the term that I've heard that I like the most for it is, it's the riptide economy, where on the surface, everything looks great. Everything is looking good. If we look at the earnings of publicly traded companies, if we look at the hiring stats of publicly traded companies, so very big, large companies, things in the economy are looking good. Growth is up, unemployment is down, and on that surface level, it's great. Everything's great. We do not know, and when I say we, economists, scholars, so people who are paying attention to this stuff, don't know what's happening underneath. There's a lot of things that are more opaque to us than they've been in the past. A big part of that is the rise of private equity. And so there's more companies that do not have a public reporting requirement. That's becoming more popular for companies to not go public. They stay private companies. And you can think of, Elon Musk is really a fan of this. So while Tesla is a public company, the Boring Company, SpaceX, Neuralink, those are all private companies. And so we, as people who are studying this, doing research and analysis, we have no idea what is going on in those companies because they don't have to disclose it. So they choose not to disclose it. And so the big question right now, as we're now kind of emerging from the COVID problems, is are we as an entire economy emerging out of these COVID problems? Do other places have um, the same type of recovery? We have a lot of people, looking at the statistics from the Federal Reserve. We say the economy's great. We're on track for a soft landing. They just had a meeting today, very optimistic, very rosy. And then you have a lot of households saying, I can't afford this. People are very pessimistic. And now that's a question of, well, are people just more pessimistic now from some other external reason, or does life suck for people? And it's hard to quantify that. And so a lot of moving forward, I'm positioning my clients to say, well, here's what we know and here's what we don't know. And here's how we can navigate both of them.
Okay, so I heard there's like on the surface stuff's looking good. Public companies are doing great, but with the rise of private equity, there's some mysterious stuff that we don't quite know what's going on. And then you have this narrative over here with the average consumer having a pretty hard life because of, my pack of 60 eggs going from $8 to $20 back down to 12. So,
Yeah.
yeah. So I guess I'm curious when you're saying, hey, here's what we know, here's what we don't know, here's what we're going to do about it. What is the here's what we're going to do about it? Is that kind of the index strategy? Is it positioning in some trusted private equity strategies? Like, what does that kind of look like?
So it's going to depend from client to client. A lot of it does come down to what you're talking about of just making sure that the allocations are appropriate, that your whatever happens, your financial plan can deal with it. So if the stock market shoots up, if it falls down, we're looking good there. Where I will differ from a lot of kind of off the shelf RIAs is focusing more on the smaller companies. So if you have someone who is strictly passive, they're going to be looking at mostly mega huge companies, these mega cap companies. And part of that positioning is diversification. When we're dealing with the unknown, we don't know what part of the economy is going to work. And so we're building in that diversification, and that can incorporate that can incorporate some alternative investments, especially if there is the tax savings there for it. But first and foremost, what's driving the boat is what's our best case scenario, what's our worst case scenario, and what can the individual person afford.
I gotcha. So the allocation really varies from person to person. I heard you mention diversification in there. So is that your primary way, given the current state of the market, to address risk in portfolios primarily through diversification, or are there some other things that you're doing as well?
That's going to be the primary way, and it is looking to some diversification that um, really in what our risk exposures are. And so risk exposure to interest rates is going to look very different than risk exposure to cyclical economies, cyclical orders. And really, what it's trying to accomplish is saying there's not any one bad thing that can happen to you that would destroy you and wipe you out.
Yeah, yeah. I gotcha. No, that's a really good strategy, and I feel like it's a basic concept, but then in practice, I'm sure, especially from person to person, given separate situations and how they feel about certain investments, I'm sure that can come into play as well. It can be a more complex thing that it takes somebody to navigate some of the complexities that come with it, as well as, um, yeah, just to make sure you're thinking about things right. It's always good to have that person that can make sure your thinker isn't going off the rails there. So no, that's important. I do want to jump to a little bit about the difference between a portfolio geared towards kind of asset accumulation and then a portfolio geared towards income. What's the main difference between those in this current market environment?
Well, you could ask folks at like Silicon Valley Bank, and it comes down to liquidity versus solvency. And so, liquidity is our short-term ability to meet our cash needs, what we need right now, and solvency, our long-term ability to meet those cash needs. And I'll tell you a story back from when I was a probate auditor. We were investigating a case. There was a gentleman who had all of his money tied up in Boulder real estate. He had about $8 million worth of real estate in the Boulder area. And at the time, we had what they were calling a 1,000-year flood, and it completely destroyed the property. Now, what I thought was really interesting about this case, because we were looking for the person managing it, was this grossly negligent, right? And so egregiously mismanaged that you wouldn't have, nobody reasonably would have done this, right? And he had the right kind of insurance. He had good renters. He had done assessments on that buildings on those properties. And it came back and said, look, this individually is a really good investment. And in the long term, you probably would have made a lot of money. You protected yourself in a lot of really good ways. But this was not for asset accumulation. This was for an immediate need. And while they had to wait several years for the insurance to finally give them the cash, and then using that cash to fix the properties back, they had to sell some of the properties, and they had to sell them at a loss because they were so badly damaged. And so the income strategy becomes not only how is this going to perform in the long term, but how much risk and volatility is in the short term, and can I spend it?
Mm, I like that. I like that. How much risk and volatility is in the short term, and can I spend it? Which touches to that liquidity piece. So I guess in that real estate transaction, it probably wasn't a very liquid investment. Am I right in assuming that?
Absolutely terrible,
Yeah.
because you can't sell a fourth of the building. You can't sell an eighth of the building. You're going to have to sell the entire building or not have money. Those are your options. And you're not going to be able to get a good loan if you just experience this loss, and you can't get renters because it's been just very badly damaged.
Yeah. Yeah. I gotcha. All right. So it's a play that, if you had a 10 or 15-year hold on it, might have been a good asset accumulation play. But for the income side, that short term risk and illiquidity probably wasn't optimal for the portfolio. And that's the real difference you're seeing there.
Mm-hmm.
I gotcha. Well, when it comes to alternatives, we touched on this a little bit. What are you doing to evaluate alternatives in today's market?
Yeah, so I think all of the traditional asset evaluation, asset pricing strategies are there. So you're looking at things like consistent income. You're looking at their ability to pay, the where you're investing, their ability to pay you those dividends, how well it fits your needs, everything that we've already talked about. What is kind of new right now, given the current market, is an additional assessment to see if is this legit? Is it a real thing? And it used to be easy. It used to be kind of taken for granted that if you have an investment showing up, that they're working with an auditor, they are working with somebody who is going through a third party verifying the quality, verifying that everything that they said is true. Now we're seeing less and less of that. And the trend line is moving downward and downward. And a lot of even legitimate investment companies are saying we don't want to spend the cost. It's extremely expensive to have an auditor come in, a third party auditor come in and give us some audited statements. But that means now you as an investor have to do that. You as an investor have to do your due diligence to make sure that these people are telling you the truth and they're doing what they're saying they're doing.
Yeah. Yeah, no, for sure. And I guess the expense of that third party audit, it's so expensive because it takes time. And now that time is on your plate, right? So I guess what does that due diligence process look like from a time perspective? Is it a lot of time digging into the financials, meeting the sponsor, walking the projects? Like what does that, and It varies from alternative to alternative for sure. But if you had to pick out two or three major things that you're really looking for.
Well, first of all, you got to get under the hood of the business model, and you have to be able to answer at a minimum the question of how am I going to get paid and how are they going to get paid, right? So we have to go in the mindset of no kid grows up saying I want to be an accountant. That never happens. We're here for the money. We're making these types of transactions because someone's getting compensated for it. And so understanding especially the person that you're dealing with directly, because you're always going to have some type of point of contact in these investments. Really understand comprehensively and have it documented, written down. So if ever you need to sue them or try to recover those funds, you have a very clear trail. What's in this for you? You know that at the bare bones is something to know very instinctively. And so, one of my favorite movies, Boiler Room, you could ask them, why are you pushing this? Well, there's a huge commission if you come and join us here, right? Where that is going to be a really good indicator that there might be something amiss. And understanding, you know, in very clear terms, how do I get paid back? How do you get paid back? And one of the examples that I'll give is a lot of the cryptocurrencies that came out, right? If the how do I get paid back answer is I have to find another investor. And the, what's in it for the person selling me this? Well, they get paid back. They get their full account balance back, right? That should be a tremendous red flag. We're not generating any value. We're not doing anything. That's not a sustainable business. If there's no such thing as investors, and you had to put your own money into this business, would you do that knowing that you couldn't sell? You had to somehow make money off of the value added. Well, you'd say there is no value added. The only value for a lot of these schemes was how many people can you get into the scheme, right? It answers those questions. The next one is understanding, like we alluded to before, the contract, which goes along with it. What's in it for me? What's in it for them? And then third, and this is a little bit more difficult, understanding their business model and what protections are in place. So what is preventing them from filing bankruptcy tomorrow? You sign the paperwork and then they disappear, right? What's preventing that? What type of assets do they have? What type of business model do they have? What kind of customers do they have? Is there anything that would prevent this from taking my money and disappearing? And beyond that, those become kind of just the baseline. Like you need to have that in every single transaction. And then it just becomes, I have to be very skeptical on everything else that I'm talking to this person. I cannot take for granted that it's true, anything that they're telling me. So if this being a good investment hinges on one assumption, right? We got to make sure that assumption is true. We have to do something to verify that's true, whether that is looking into financial statements, getting an expert to look into those statements, asking them to give you an audited statement. We got to make sure that all of those assumptions are rock solid before giving any money out.
I love that. So it's the what's in it for you, understanding the contract, understanding the business model, and then kind of a sub point under understanding the business model is really making sure that the assumptions that they're basing their whole business model on are solid with verifiable proof. I like that verifiable proof there because a lot of times you can just assume something and then it's taken as like, oh yeah, real estate appreciates at 3% per year. Well, will it continue to appreciate at 3% per year? Can we verify that? Yeah. No, I like that a lot.
And everything is going to have assumptions built into it, but understand them and know what it is. And if back with the other one, the model is, we assume real estate's going to grow at 20% per year. Like, well, that's maybe not a reasonable assumption. What are these assumptions here, and can I think critically about them, knowing that the guy on the other side of the table is probably going to get a paycheck for selling you something?
Yeah, absolutely. And that I really like the honing in on understanding the incentives because it kind of leans towards, getting to know the manager and getting to a point where you can do business with them well. Because, yeah, you got to trust their character, but you can have somebody with really good character put in a position where the incentives aren't aligned, and then you could have a situation that isn't beneficial for both parties, right? So I like that, really understanding the incentives and the assumptions there. Now, I'm curious though. So, after you've gone through this process, you understand the business model, understand the contract, understand the what's in it for you, and those assumptions are solid. Say they get through that due diligence process. What role are you looking for alternatives to play in portfolios, if any?
First and foremost, you get a lot of tax advantages. And so if you can hold that in a type of structure that has an advantageous tax back to you, so like a REIT or some type of MLP that has something special about it, some special tax benefit, that is something that's extremely unique that you're not going to be able to find in other places. That's going to be very unique, and it is really and in for a lot of taxpayers after maxing out their 401k, after kind of maxing out the no-brainer places to put your money, right? The very easy hiding places, it becomes a much better hiding place for your money where it's not going to be subject to that ongoing income tax. It's not going to get kind of chipped away from the income tax. Selfishly, I will say, since I write the tax returns too, there's a bit of an incentive because it does complicate your life a little bit, but it can complicate your life to save you lots of money in many cases. We would never do it unless there was some value to taking that more aggressive position.
Yeah, yeah, no, that makes a lot of sense. And I guess with taxes, you threw it in there with fraud earlier in the podcast, which is, it's just funny. It's funny. Good time.
Well, it's here's the deal. There are things that can eat away your wealth very quickly, and both of them impact the person paying them very immediately, very quickly. And so, if you are not paying attention to it, it has a very material effect on your life.
Yeah, yeah, that's a good way to put it. But I guess when you're looking at taxes, and the tax advantages of alts, are you selecting alts for portfolios not purely based on those tax advantages, but with that being the first consideration?
Typically for me, in a lot of cases, for my client base, that's where it plugs in. That's where it plugs in because we are having to reevaluate with alts. We have to generally reevaluate the risk and return, and it's that any of those deviations kind of from the cookie cutter models, we need to really pay very close attention to them and make sure that they fit really well. And so there usually needs to be a reason from it. A lot of times the cookie cutter models are that way for a reason, where it's easy to apply to many, many different people. And so a lot of times for me specifically, the alts are going to be a one-off to solve some type of tax problem, to solve some, basically, it's a very valuable tool that can solve a lot of problems, but I am not going to go looking for problems because there's cool tools out there.
Yeah, yeah. That makes a lot of sense. And so I guess this question might be a moot one, but are there any specific alts, one or two, that you find intriguing enough to do some research on with 2024 coming up? And this is not to endorse them, just to say they're interesting enough to do some research on.
Oh yeah, real estate is it's huge. I mean, it's easier than ever to have some direct exposure to real estate, whether that is in the physical properties, the management of the properties, or the direct ownership of the debt on those properties. And that is that's one that's always near the top of my list. And then oil and gas exploration is another one that is on top of my list, just because you get in a lot of cases, you can get the write-off sooner. It's sooner to get that recovery on that side of things. Into the future, I think it is certainly worthwhile to look at collectibles and even digital assets, however that manifests itself. I am a firm believer, though, it's the Wild West right now, and it's the golden age of fraud. And so you really have to be careful with it. And I think having a stronger regulatory environment is probably what is going to move more alternative assets into the limelight. And it's going to make it easier and more accessible for people when there's accountability and transparency and integrity in the markets.
Yeah. Yeah. And I feel like with a lot of that, though, like the huge push in that space right now is the decentralization, the like lack thereof. And so I'm curious to see how those clash in the next, 5, 10, 15 years and what it comes to.
Yeah, a lot, I don't want to overgeneralize. A lot of the digital assets world is, there's kind of a breakdown, and I'm not going to say what I think the percentages are, but there's really kind of three folks there. One are people who think they're legitimately solving a broader problem, right? So you have some type of digital asset or some type of cryptocurrency that is fueling a problem that we existed, like smart contracts, right? You can solve this bigger, broader problem that's going to save people money, right? I think that is the future. That is what does have a future. You also have very ideologically driven pushes, and these are people who kind of think we're going to, go be able to replace currency. We're going to be able to move it and get the government out of the way, right? And that philosophy is about as effective as burying silver in your backyard. In the apocalypse, this would be great. I am not making my financial plan for the apocalypse. I'm going to assume that in 20 years, the government's still going to be around. And also, even if you have that ideology, don't you think that if there was a currency on the rise that was going to replace the US dollar, don't you think the US government would do something about it? Do you think they would just say, like, yeah, great, we're out of the loop now, and that's fine with us? And then the third component is scams. They're just scams. There's no value. There is no future. It is simply get the money while you can. And right now, I don't know where those percentages are. And honestly, the same can be said for any type of unregulated thing. Anything that lacks that regulatory oversight. There are these very ideological people who say, yeah, this is the future because the stock market is corrupt. It's like, okay, well, maybe, but how is this going to play out in the end? That the NASDAQ is just going to say, put their hands in their pockets and say, oh, well, we tried, and just let that happen. It's a recurring theme for sure.
Yeah. Yeah. I do like your point about how some of the technology, specifically regarding smart contracts, like that has a very practical business use, will solve a problem, like that will definitely be in the future. And then whether or not certain currencies overtake other currencies or whatever, like seems like kind of what you allude to, there would be a lot of resistance from the powers that be if that ever did start to happen. So it would get real ugly before it got pretty. Anyway, but the smart contract use and other technology uses, that's really valuable. And as that does pop up with some regulatory aspect to it, I can see it being a huge place of investment once it's safe and accountable and all that stuff. So
Right. And I think the heart of finance overall, whether it is kind of your more traditional securities or alternative investments, is trust. You are trusting someone with your money. That's the beating heart of this. And if an industry erodes that trust, from a financial standpoint, from a capital raising standpoint, there's no reason for it to exist. If they do not have the trust of investors, it is not viable. It's not legitimate. It's not going to be around.
Yeah. Yeah. No, for sure. Absolutely. Well, cool. We want to jump kind of back to you and back to your firm. Tell us a bit more about what really sets you apart from other financial advisors and how people can tell you apart.
Yeah, I think for me, it was a very in depth view of things and an in depth deep dive into what are we looking at and having the ability to really explain it. And I have a lot of clients who had frustrations before where their advisor was kind of hand wavy or they weren't really taking the time to explain something. Now, I don't know if that's because the advisor didn't understand it or simply they didn't set aside the time to explain it to their client. But that's kind of the place where I fit in. So I tend to work really well with very analytical clients who want to know the details and want to understand how things are getting done. And the other advantage being I'm both a CPA and a CFP, which doesn't give me the option to kind of pass it off. And there's so many advisors where everybody's pointing fingers at everybody else of, well, I'm just your financial advisor. You got to ask your accountant. And your accountant says, well, I'm just your accountant. You got to ask your financial advisor, where the client is left in this hole in the middle. I don't have the luxury of dropping people off in that hole. I have to answer there because I don't have somebody to point to. If there's a tax issue, whether it affects the financial plan or the tax return, I'm the person answering that, which I think is pretty rare.
Yeah. No, for sure. For sure. Well, cool. What do you think is the most important part? So I noticed you said clients will come to you and, you'll be able to answer both sides of that coin. And we talked about how trust is important in the finance industry. What do you think is most important to that ideal client advisor relationship?
It needs to be accuracy and integrity. And so someone can go get maybe correct information from ChatGPT, right? Or Googling it or TikTok or whatever, right? You can get information that is maybe correct. The whole thing that I am selling is information that is consistently correct. And you know that it is not a guess. It is a fact. And having that integrity of this is always this way. It is always going to be something that is factually true and thought out as opposed to something that is maybe true or a guess.
Yeah, no. And the thing about that is it is so important to be consistently right, because if you're wrong 15% of the time, and in that 15%, you put a lot of money in some fraud, you're really going to feel it. So
Yeah.
that extra percent of being right, consistent, and taking the time to do the deep dive and really understand what you're going into is a very important thing. Well, Robert, I do think that is all we have for you on the show, unless you feel like we missed anything. Is there anything else you want to throw in there?
No, I think that's great. It's very much appreciated. I had a wonderful time.
Yeah, no, it was a great show. And if people want to know more about you or want to dive into the kind of analytical nature that you bring, where should they go to contact
Best place, the best place to contact me is going to be delagify.com, Delagify. You can send a message or schedule an appointment there.
There we go. Well, Robert, thank you for coming on the show. Guys, thank you for watching. The ways to contact Robert will be down in the show notes, and we will see you guys on the next one.